Hi everybody, this is Lara with your end of the week video for the S&P for the trading week ending Friday 3rd of May. I'm expecting a pullback or a consolidation here for primary 4 to last about a couple of weeks or so. It could find a low about 2894 or, if it's time consuming enough, the lower edge of the maroon channel on the daily chart. For the shorter term, I'm expecting some downwards movement to begin next week to about 2894, and overall I'm expecting primary 4 may be a big range-bound movement. The final targets remain the same, and I still have my two preferred wave counts at the weekly chart level. If you really want to see the difference between these, it's best to view them at the monthly chart time frame, and I link back to my monthly charts every day at the beginning of every article. This wave count sees a grand supercycle degree first wave coming to an end possibly in October this year. The final target for it remains the same at 3045. One reason why I like labelling this impulse beginning in March 2009 with 1 off to the left of the chart, 2, 3, 4 is when we do that and we draw an Elliott channel from 1 off to the left of the chart to 3 and put a copy on 2, it almost beautifully, perfectly shows where 4 found support, and the third wave of the third wave have the strong overshoot at the upper edge of the channel. This is such a very typical look for an impulse for this market. It's almost textbook perfect for the S&P, leading me to think that my labelling of 1, 2, 3 and 4 may well be correct, given it has such a good look. If 4 is over here, then 5 is underway, and it may not be longer than 3. This wave count has a limit, because here 3 is shorter than 1. 3 may never be the shortest actionary wave within an impulse. It doesn't mean it has to be the longest. I have seen that rule misinterpreted. That's not what it states at all. The rule is the third wave may never be the shortest. It can be shorter than the first wave, and when it is, it limits the fifth wave to no longer than equality in length with the third. In this instance, that limit is at 3477.39, and I need to add that little piece of information back into my text article. The target would see cycle wave 5 end before that limit, and so all Elliott wave rules for the impulse of super cycle 5 would be met, and so that's why I'm applying a Fibonacci ratio for cycle 5 to reach 0.618 times the length of cycle 3 for my target. Cycle 5 must unfold as a 5-wave impulse. Let's take a look at this now at the daily chart level, where cycle 4 is a slowdown here. Cycle 5 may be a smaller fractal of supercycle wave 5. Supercycle 5, which you can view on the monthly chart, has a long extended first wave, a second wave correction, which unfolded as a combination, and the third wave is shorter than the first wave, and then the fifth wave needs to be shorter still. Cycle 5 also has a long extended first wave. Here's a flat correction for the second wave. A third wave impulse has a really good fit, and now it's expecting a fourth wave to unfold, and then a final fifth wave would need to be shorter than the third wave, or at least not longer than the third wave. It could reach perfect equality, and the Elliott wave rule stating the third wave may not be the shortest would be met. Labelling cycle primary 1, 2 and 3 over here, and then drawing an Elliott channel around this movement beautifully shows where these upward candlesticks found resistance. I'm drawing the channel from 1 to 3 on this candlestick here, placing a parallel copy on the end of 2. I am expecting a relatively shallow sideways fourth wave correction. It may unfold as a combination or a triangle now most likely. It could also be a zigzag. It could be sharper and deeper and find support about the lower edge of this channel. Primary 4 may not move into primary 1 price territory below the invalidation point. The final target at this stage remains the same. When I have the end of primary 4, I will then also calculate another limit for primary 5 and possibly widen this target to a small zone, or at that stage it may change. At the hourly chart level is not a problem, but something I'm not entirely comfortable with about this wave count. From this high to this low, this downward movement looks really strongly like a 5-wave structure at the hourly chart level. When I look at it on the 5-minute chart level, it also looks best as a 5, but it is possible to count it as a 3 as A, B, C with 1, 2, 3, 4, 5. That's possible. This is the problem I have with giving you this invalidation point here. My experience with this market over the years shows that its 3s don't always look clearly like 3s at all time frames, and its 5s don't always look clearly like 5s at all time frames. It can be misleading. And so it is possible upward movement could continue early next week to make another new all-time high. I could be premature in labelling this invalidation point over here, and the AD line giving us a bullish signal at the end of the week supports the view we may see a new all-time high early next week. If we do, though, it does not mean that I'm going to label primary 4 over here. It still would mean I'm going to continue to expect primary 4 has arrived and will continue in a big sideways movement, possibly for another week and a half to 2 weeks or so. There are still more than 23 possible corrective structures that primary 4 can unfold as. All we know is the least likely of them would be a flat correction because it's likely to exhibit alternation with the flat correction of primary 2. That still leaves the zigzag family, single, double and triple zigzags, all the combinations and triangles. And so the labelling of primary 4 as it continues sideways over the next couple of weeks or so may very well change. Today I'm going to consider a fairly common structure, a double combination. We may have a 5, 3, 5 zigzag to continue lower early next week to complete a zigzag for intermediate wave W. When the zigzag is done, we may be seeing a 3 in the opposite direction for X, most likely to subdivide as a zigzag, and then intermediate wave Y may unfold as either a flat correction, most likely, or a triangle, least likely, to complete a combination for primary 4. Now I could relabel this as ABC to complete wave A of a triangle for primary 4, and then we could have B, C, D, E, overlapping sideways movement in an ever decreasing range to continue for a couple of weeks or so to complete a triangle for primary 4. At this stage I don't want to separate the ideas out into different charts, but I may well do so in the next few sessions. Only if we see a new all-time high on a strong upward day, which should have good support from volume, and the AD line, would I revise the idea that primary 4 may be underway. At the weekly chart level, this wave count is seeing the subdivisions of this bull market beginning in March 2009, all of it in exactly the same way as my first weekly wave count, not preferred, just the first weekly wave count. I'm going to label them first and second because I'm not going to prefer one or the other. And then I've moved everything down 1 degree, and you can see the big implication of doing that on the monthly chart. This wave count expects that after the impulse, which I'm now labeling cycle wave 1 may be complete, that when that's complete, it would be expecting a bear market for cycle wave 2, and so the minimum 20% fall in price from the final end of the bull market would be expected for cycle 2, but it could be over in just 1 to 7 years. It could be deep, but it also could be relatively shallow. And then a huge third wave at cycle degree would then be expected. And so the longer term implications are really quite different. And I do encourage members to have a good look at those monthly charts to see the difference. We still need to see this final fifth wave here labelled primary wave 5 complete with intermediate 1, 2, 3, 4 expected to unfold sideways over a couple of weeks or so, and then a final fifth wave up. The targets are the same, the invalidation points are the same, the trend channels are the same, the subdivisions are the same. It's just the degree of labelling at the monthly chart level which differs, which has a really big implication. But we're not into that yet. We won't get into the difference in expected direction or implication until this impulse here is complete, and it's not complete yet. Okay, let's take a look and see how the week ended. It's ended as a doji candlestick. A doji on its own is not a reversal signal. If we have a bearish weekly candlestick to follow it, then that may be an evening doji star bearish reversal pattern, but that hasn't unfolded yet. You can see doji within upward trends. They just represent a relatively small pause, a breather within the trend. And so that's what we have this week. And finally, the long expected new all-time high from the S&P this week. That hasn't been followed through all large, mid and small caps though. It's only large caps that have done so. Mid and small caps are lagging. That's pretty typical of an aged bull market, and so that fits the bigger picture as well. Volume this week supports upward movement. This is quite bullish. On balance volume makes a new all-time high with price, so there's bullish support there. RSI is neutral. It's not yet overbought. It can reach overbought and can remain there for many weeks. And so just RSI getting overbought does not mean upward movement has to end. Plenty of room for this bull market to continue. ADX is above 15. It's increasing. It's coming up from a low level below both directional lines. This is the strongest signal ADX can give. It tells us there is an upward trend. There's very obviously an upward trend. It's in place, and it's telling us it's still relatively in its early stages. MACD is full bore bullish. Everything in this chart is bullish. The doji candlestick is the only thing here that is offering a very weak sound of caution. At the daily chart level, there was a bearish engulfing candlestick pattern for Wednesday's session though. That's a stronger sound of caution. RSI reached oversold. Stochastics reached overbought, not oversold. RSI and stochastics fully reached into overbought. This trend is quite long now, and now with those two indicators extreme and a bearish engulfing candlestick pattern, that sounds quite a strong word of caution that supports the Elliott wave count that expects some consolidation to relieve those conditions. Support at the moment is about 2875. For Friday's session, volume did not support upward movement. And that would tend to indicate this could be a B wave, which I've labelled it for the short term on my hourly chart. But in current market conditions, price can rise and has been doing so even at the monthly chart level for years on light and declining volume. So that's not really much support for my short-term Elliott wave count. ADX was telling us there was an upward trend. It's now declining, telling us that at this stage there is no clear trend at this time frame. ATR has been declining. That's absolutely normal for this market in a bull market. On balance volume made a new all-time high with about the same time as price, supporting the new all-time high from price. This is bullish. We've been over RSI and stochastics. And take a look now at the AD line and inverted VIX. They are contradicting each other this week. Both price and the AD line this week have made new all-time highs at the weekly chart level. Every single bear market from the Great Depression and onwards has been preceded by an absolute bare minimum of 4 months bearish divergence between price and the AD line, according to Lowry's research, and I give them a lot of weight. They're very established and well respected. They have some really good data. And so the AD line making new all-time highs tells us that a fully fledged bear market now is a bare minimum of 4 months away. That's in early September. At the daily chart level, this is of a concern for the short-term picture for my Elliott wave count, and that's one reason why, when I looked at that hourly chart with you, I sounded a note of caution about my invalidation point. It is possible we could see a new all-time high as another one as part of primary wave 4. It could happen early next week. Upwards movement for Friday came with rising an increase in market breadth to support that upward movement. The AD line has made another new all-time high. Price on Friday failed to make a corresponding new all-time high. This divergence is bullish for the short term and does not fit with the view that this was a B wave within a consolidation. It could fit if we see price move higher and the AD line move lower, and price make another high, and the AD line may then show some bearish divergence, and then that could fit. But for now, with the data in hand, this is telling us to expect another new all-time high early next week from price. However, this is the reason now why I am still going to consider primary wave 4 may be underway. There was a decent size fall in price at the weekly chart level here. This was the end of what I have for my first wave count. I have labelled primary wave 3 within cycle wave 3, and here's a triangle for primary wave 4. The end of primary wave 3 and the beginning of some strong downward movement for primary wave 4 came with warning from inverted VIX. 1, 2, 3 weeks price moves higher, and for that 1, 2, 3 weeks inverted VIX moves really quite strongly and clearly lower. 3 weeks in a row of clear and strong bearish divergence was followed by quite a big consolidation. We may be seeing that again. 3 weeks price has moved higher, this week making a new all-time high, which we'd expected. 3 weeks in a row now, inverted VIX has moved lower. It's not as strong as it was here, and so maybe the consolidation we may be about to see may not be as strong, but this divergence has happened before, and this is what happened. This supports the view that primary wave 4 may be about to unfold. Now, this could continue for another week or so before primary wave 4 really gets into some strong downward movement. But this does support the Elliott wave count at the daily chart level at this time. For the short term, there was bullish divergence for Thursday. Price moved lower, but inverted VIX moved higher. That bullish divergence was followed by upward movement on Friday, and it may now be resolved. For the shorter term, there's this divergence here between highs between price and inverted VIX. Inverted VIX moved higher for Friday, as did price. For the short term, there's no new divergence, but this bearish divergence at the daily chart level does still remain. So inverted VIX is now sounding quite strong notes of caution and supporting the view of a bigger consolidation has possibly begun here or may begin really soon. That's all from me with your S&P analysis, and I hope our members are having a fabulous weekend.